that 60, right? That equity portion. That is where we're seeing potential risks arise as a direct result of some of these disruptive innovation themes that we're focused on, right? Because Hi, I'm Ren Leggi, Client Portfolio Manager with ARK Invest. On this season of The Switch, we're going to address how innovation performs in times of market turmoil. As always, we'll be joined by ETF Trends to facilitate the discussion and make sure that we don't leave anything unanswered. So let's get the conversation started and look at rethinking asset allocation.
Let me dive in first, Ren, if I can. We're surveying advisors all the time, and regarding portfolio construction, they're really concerned about 60-40. They're concerned, more importantly, about the 40 part.
Yeah, I mean, that's been known to be kind of the tried and true allocation, right? But when you hone in on that 60, right, that equity portion, that is where we're seeing potential risks arise as a direct result of some of these disruptive innovation themes that we're focused on, right? Because investors have exposure to some of these broad industries that we believe are becoming more vulnerable to disruption. And when you look at how these investors are constructing that allocation, that global equity allocation, right, it's based on the premise of backward-looking metrics. That may not be the case when you're trying to construct these portfolios over a longer term time horizon. That may not be a successful, strategic allocation. We need something that is going to look at and provide exposure to these innovation platforms that we think will actually create a tremendous amount of value and wealth creation over the next 5-10 years. And we just see, when we look at the global equity market, we see a lot of industries that may not even be around any longer. They will be replaced. And, many investors just don't have that exposure to some of these larger innovation areas.
One of those challenges of advisors increasingly putting more money into equities because they just don't think they can get much out of the bonds, as Tom was saying, is they just sort of level up, right? They just add more to their existing allocations. But what they're not doing is really capturing any correlation benefits, right? If you're getting rid of the bond portfolio to put more equities in and you're just buying more cap weighting, that's not really going to get it. Have you guys looked at all about where in the style boxes something like innovation should land?
Yes, I mean, that's one of the challenges that I think allocators are faced with when it comes to innovation, right? We're very style box oriented as allocators because we're thinking about asset classes and we're looking at value versus growth, large cap versus small cap. And really, innovation cuts across all of those. It cuts across the style boxes. It cuts across industries. It cuts across sectors. And it does cut across market caps. We think it really does deserve kind of its own style box, right? It almost sits out and to the right when you look at kind of your 9-box Morningstar style box, right? It's beyond kind of growth. This is the future. And, we can, having an exposure across that spectrum, we look at it as an all cap global exposure to innovation, right? And so I think I think that's been one of the challenges. But as more and more investors are starting to think like that and think outside of the box, right? They are starting to get warmed up to this idea of innovation actually fitting into kind of a strategic allocation.
Yeah, and getting back to the 60-40, Ren, and you look at the challenges that we're seeing in a inflationary environment, rising rate environment, where that 40% may be in tough shape for the next 5-10 years, and more money's moving over to equities. But at the same time, investors tend to be squeamish based on volatility. At ARK, you folks have always had a longer term outlook. And if advisors understand when talking to their clients, especially those that might be retiring at 65 or 70, have another 20 or 30 years to live, they really can get through these periods of time with diversification and participate in the future companies that are really going to set records and where you should be down the road.
Yes, Tom, I think you make a great point there, right? Fixed income could potentially have negative yields going into the future, right? Especially if interest rates rise. So they've turned to equity. And yes, one of the fears I think is around innovation and maybe technology-oriented stocks has been around this volatility, but it's mainly, I feel, kind of more short-term oriented, right? And to your point, many investors have a long-term time horizon. Even if they are 65, they may be looking to leave their wealth to their children, right, and pass that along. And so that even extends their time horizon even further. So that's why it's even more important to kind of, not get too caught up with short-term volatility. We see it as an opportunity, right, to take advantage of that, just in our kind of innovation-based style investing. But when you look at that longer term time horizon, we see that these opportunities outweigh that potential risk. And so I think it's important with pairing, you always want to have a very diversified portfolio, right? So you will have some fixed income to meet those short term needs. But when you're looking at that longer term portion of your portfolio, that growth portion, I think that's where innovation really plays a crucial role.
I feel like we've been in this situation a few times before when we've had advisors sort of looking at their plain vanilla allocations and saying, well, that's not kind of doing what I wanted to do. I need to look further afield. I know you've done some work on that. Tell us what you found.
Yes, so we conducted a study looking at kind of including a sleeve of innovation into kind of your traditional global equity portfolio, right? Most investors have certainly in the U.S. have a home bias to the U.S. So you look at it around 60% or so. They also have developed international exposure, maybe around 25 to 30%, and then the remaining kind of 10% is around emerging markets. And so when you look at that global portfolio and you slot in innovation anywhere from 5%, we looked at from 5% all the way up to 15%. And what we noticed was that it provided diversification because the correlation to those other kind of broader asset classes within equity or sub-asset classes was fairly low. And so it actually provided increased diversification and better risk-adjusted returns. So when you look at over a longer term period, it actually dampened volatility, and it also dampened the max drawdown. So you saw improved Sortino ratios, which is based on downside deviation, with enhanced returns. So again, this is a study, right? We looked at it. Actually, we conducted this pre-COVID and post-COVID, and the results were very, very similar.
Coming on top of that, Ren, coming out of the financial crisis with $600 billion in assets, we've now 10x the amount of money in ETFs. A lot of advisors are ETF fans as self-directed investors. But during that period, we've seen a very high correlation on the equity side to the S&P 500. Now, that's worked really well for an extended period of time. But we're starting to see people get a little less satisfied with the valuation and also with the high weight of just a handful of stocks there. Can you talk to that and what adding innovation, especially a little bit of diversity to the S&P might bring?
Tom, that's another good point, right? When you look at the FANG stocks, for instance, right, and we've had some exposure to them in the past, but they are really dominating indices like the S&P 500, and if you look at the Nasdaq, I think it's over 35% exposure, right? And that really speaks to just the nature of these market cap weighted indices, right? They're based on past success. And we know that may not be indicative of future success. And so you want to kind of invest for the future, and you want to identify these large opportunities when it comes to, and we're centering that around kind of these innovation platforms, DNA sequencing, artificial intelligence, energy storage, robotics, and blockchain. And these could create, according to our estimates, we've revised it. It actually was 75 trillion in market cap appreciation. When it comes to those 5 platforms by 2030, we think it's going to be above 100 trillion. AI alone could be 100 trillion. So just one of those 5 platforms. And I think investors just don't have enough exposure to these large opportunities because those indices don't have those underlying stocks incorporated in them because, again, because of that market cap weighted bias. Some of these companies are smaller, some are larger, some have not been around as long, some aren't profitable, right? So they may be excluded, and they haven't been profitable for at least 4 quarters, so they may be excluded from the S&P 500. So I think that's one of the flaws that come into maybe passive. I think there's a place for both, right? That's not the discussion we're trying to focus on, but there's a place for both. But you want to complement that. You want to provide that diversification. You can't put all your eggs in one of those baskets, right? So I think there's a dynamic and kind of a complement to one another.
Yeah, Ren, putting too many eggs in one basket is never a recipe for success. Thanks for sharing your thoughts here on asset allocation.
Thanks, Dave and Tom. Looking forward to seeing you on the next episode.